Hello and welcome to FinCrime Unfiltered. I'm Sarah Beth Felix. Just a quick note to everyone out there, there's a free webinar coming up I think you should check out. It's called Everyday AI for Compliance Teams, and it's being hosted by our sponsor Hummingbird on June 25th. It's a practical look at how investigators are using Hummingbird's AI tools to work more efficiently. Things like reducing repetitive tasks, speeding up casework, and writing clearer, more consistent narratives. Why? Because the goal of compliance AI is not to replace judgment, it's to give you more time to use it. That's all happening Wednesday, June 25th at 11 a.m. Pacific, 2 p.m. Eastern, and you can register at hummingbird.co/illicit edge. Again, that's hummingbird.co/illicit edge. Hi, and welcome to episode 9 of FinCrime Unfiltered. I'm Sarah Beth Felix. Thanks for joining us again. And like I've said, the last couple episodes, I keep getting really nice and encouraging notes. So please keep it coming. For every one nice note, I get, probably a grumpy note as well that does not agree with some of my takes on things. So I definitely appreciate the encouraging stuff. And also the stuff that keeps challenging me. I'm definitely open to that. But I wanted to say I've received, I think, about 15 requests over the last week and a half for the front company indicators I offered up, I think, in episode 5 or 6. So if this is your first episode that you're listening to, I did make that available to all financial institutions. If you need a starter list, a starter package of what a front company looks like, some are programmable, some are not. If you want to reach out to me at FinCrimeUnfiltered@illicitedge.com or find me through LinkedIn at I Follow Dirty Money, I'd be happy to send that along. All right, so we have a little bit of a busy week, a wee bit of a busy week. We have a few things to address, and I'm going to try and keep this at 30 minutes, so it'll just be kind of a light touch on probably 4 things, at least. I tried to boil it down to 4 timely topics I think we can talk about. The first one would be the federal bank regulatory agencies. They published a request for information on payments and check fraud. The FATF this week also published their updated recommendation 16, which has to do squarely with the travel rule, which I talked about in episode 7. OFAC is finally churning out some penalties here. We've had 2 issued over the last week, totaling $218 million. Of course, one of them was $215 million, yikes. And one of them was $3 million of a penalty. And then I wanted to briefly go through for securities firms, or basically any firm. You don't necessarily have to be in the security space, but this one was published by FINRA. And it addresses a defunct AML officer position, someone who sat in the position, and over 10 pages of this consent order that FINRA published, they went through and talked about how this person did not do their job. So we're going to talk about if you are in management or on a board of a securities firm or a credit union or a bank, these are some things to look for. All right, so jumping into the joint banking agencies guidance, I do want to say I again saw that the NCUA was not part of this. I don't understand why they're not part of these. When they released the third-party risk management guidance, both rounds of it over the last 18 months or 2 years, the NCUA was also not included in that, and I still don't understand that, because it's not like credit unions aren't banking fintechs and they aren't banking, that they aren't involved in BaaS, banking as a service. So they are, and credit unions definitely experience fraud from payments and checks. So I'm not sure why the NCUA is not included in this joint banking agency release or the request for information. So the RFI has 27-ish questions, I think, and it covers everything from wires to ACHs, checks, and instant payments, which to me are still mainly going to be on the ACH rails, even though some might be on card rails. So they have a lot of questions. I think if you are listening to this and you are an AML officer and you're in charge of the fraud division, I would encourage you to carve out some time. If you have some interns for the summer, maybe ask them to start writing your responses to some of these questions. This is real important that financial institutions and actual people, boots on the ground, operators are responding to this. Because if you don't respond, then you have these bank lobbying agencies that respond, and those bank lobbying agencies are only talking to the C-suites, to the real C-suites, and they aren't talking to your team or you, most likely. So the information that gets provided to these joint banking agencies doesn't actually come from people who are the ones in the trenches digging through all the fraud stuff, trying to prevent and detect and report fraud. So if you are an AML officer, you have an intern for the summer, hand them this RFI and say, hey, please pick out 5 questions that you think that we can answer. So the reason why is because this RFI is asking for information um, regarding what the federal banking agencies can do to help alleviate the huge amount of fraud that we're seeing, and that's not just in check fraud, but in scams and other ways. So when I read this, of course, I read it, and my first question was kind of what I talked about in a couple episodes ago about how the OCC addresses P2P fraud, but won't necessarily talk about travel rule. And of course, this is related and this is unintentional, but this is highly related to my second point that I'm going to talk about regarding the FATF and Recommendation 16. So, but for this joint banking agency RFI, the potential changes, that question, which I think is question 9, if I remember correctly, that question I think needs to be answered at least at least answer that one question. You don't have to answer all 26 or 27 questions. You can answer just one question if you want. But the question that they pose is what potential changes to regulations, apart from like Reg CC or something that they name, could address payment fraud and mitigate the harms from payment fraud to your end bank customers. And I think that is the question that I'm going to answer, and I'm only going to answer that question. And that is travel rule. We do not impose travel rule requirements, like I said a couple episodes ago, on ACHs. It's only on wires, and it's only over $3,000. The reason why travel rule is important is because if you don't have the information that travels with the payment, then how do you know that it's fraud? And you can't know that it's fraud or illicit, right? If we're going to get into the money laundering thing, but if we stick with just fraud, you can't know if it's fraud and make a good decision to protect your end bank customer if you don't have the information that travels with the payment. And I know I talked about a couple episodes regarding ISO 222 and how the Fed is not going to enforce that on domestic ACHs. So here we are left again without really any way to combat fraud within the US because we don't require certain information to travel with that ACH payment. So if you're going to answer any question and you have like 5 minutes, just answer what potential changes to regulations could address payments fraud. And I would answer it and encourage them to come in line with the rest of the world when it comes to domestic payments on the ACH rail, not just wires. But that also flows down to the end fintechs and P2P platforms. We know that now going into recommendation 16, that the FATF is looking at changing up what their old school view was of recommendation 16, which the last time they touched that was when crypto came around. But recommendation 16 is not just for crypto; it is for all types of payments. And they talk about it's quite a lengthy update that they published, I believe yesterday is they're almost 30 pages. But they go through and they talk about instant card payments. They talk about electronic payments. They talk about wires. They talk about crypto. It's a pretty interesting read when you read through and you're like, oh, wow, this is what the FATF is doing on all these different types of payments. And then we have the US that only imposes travel rule on wires over 3,000, and that's it. So going into the FATF, Financial Action Task Force, the U.S. received, I believe in 2024, in our mutual evaluation 2024, we received partially compliant rating in this particular recommendation number 16. The comments, when you read the comments of the mutual evaluation, they only address the wires over 3,000. There's a few, kind of benign, but mainly kind of benign critical a little bit about how we don't have explicit requirements for travel rule compliance for MSBs and things like that. They do talk about our dollar amount being 3,000, but they don't criticize us for that, which I found odd because our peer nations, their travel rule threshold is much lower than ours. Some are a couple $100, and we're sitting here at $3,000 and only on wires. So as you read through, of course, if you have time, which most people don't, but if you get a chance to read through, just kind of skim through what they are expecting other countries to implement from a travel rule perspective, where the US is, which is pretty much the back of the line in terms of compliance on this one. And then we have our federal banking agencies that are like, oh, we need to detect and prevent fraud. And, to me, these are very much related issues, and we can't address the fraud and consumer protection issue without also addressing the travel rule deficiencies, if you will. So one of the things I did really appreciate from the FATF that they talked about was that the payment chains have grown more fragmented, which, I'm a huge fan. If you've ever been to any of my training sessions, I always kind of put an FATF quote with a FinCEN quote because they both say the same thing, but the FATF's is more like, how do I say, more real talk. It's more banker talk. It's not as formal, not as lawyery as what FinCEN says. So when the FATF says things like that they realize that payment chains have become more fragmented and it's difficult for financial institutions to have sufficient information to comply with sanctions and to detect and deter fraud, I'm like, yes, that's real talk. So for me, that's where I go to when I need something real, not something that's been too formalized. I did and do think it's interesting that we're seeing kind of this travel rule issue that no one's really addressed forever in the US. For decades. No one's really addressed it, and it's kind of coming to a head because fraud. But I think, like the FATF says, it's not just a fraud issue; it's a sanctions issue. How do you comply with sanctions when that information is not passed on in a complete way? And there's some interesting recommendations in that recommendation number 16, where they talk about for cross-border payments, where if you don't have a date of birth, that you have to at least send the year of the date of birth in some of these payments. And I think operationalizing that in the US, that's certainly not going to happen. I think, at least during my career, I do not see us complying with that at all. But I think for the rest of the world, they're pretty far down that path because they're already doing this at a much lower dollar level and across all different types of payment rails and types, where we're only doing it, again, for wires over $3,000. So if you have a chance, definitely read the FATF recommendation 16. If you don't have a chance, just take my word for it, or maybe stick it in AI and have it give you a summary. But if you have a chance, please respond to the federal banking agency's release, RFI, on payments fraud, and answer just that one question. I think it's question number 9. What changes to regulations? And I'm going to make mine pretty short, but it's going to be we need to reassess the travel rule in order to make a dent in any of this fraud. Okay, so that was item number one. Item number two. So let's move on to item number three. We had several penalties, well, two penalties, which to me is a lot because we've had 5 months of no penalties under OFAC, under the Office of Foreign Assets Control. And that is the longest time in the last several years. It's the longest quiet window that we've had. And the first penalty they released was for a venture capital fund. It was a 215-ish million, 216 million, if you round up. It was a hefty penalty that they issued towards this venture capital fund. The U.S. Treasury definitely was not playing on this one. I think I wrote that in my post. But, you know, this is the first time, and I went back through almost 2 years of penalties. And it's the first time that I saw a penalty that was the statutory maximum penalty. And that was the penalty that they got. Most times we see a fraction of the statutory maximum penalty and then the actual penalty that's settled upon between the lawyers and OFAC. And also, this is the only one that I could find, at least in my records, that only listed one mitigating factor. So when they're assessing this penalty, they have aggravating, not aggregating, aggravating factors, and they have mitigating factors. The mitigating factor, there was only one listed, and the only one listed was that they had not had a prior OFAC penalty in the last 5 years. And I mean, I shouldn't be laughing because that's very, very expensive for this company to fix. But to me, it's an example of, hey, we've had OFAC for 75 years. We've had it for 75 years. And this particular one for this VC fund, GVA Capital, it was difficult to try to find too many lessons learned. You know, I like to operationalize things and say, hey, these are good reminders. But as you read this penalty, basically the bottom line is don't do bad stuff. I mean, this company knew that they shouldn't be doing what they were doing, and they still did it. And then they got creative to get around it because they knew they shouldn't be doing it. I have more details in my post, but that really is the bottom line. If you know you shouldn't be doing something, don't do it. I mean, that's a lesson we teach our kids. And then we have these big, multi-billion-dollar VC funds that are like, oh, well, that doesn't apply to me. I'm sure it doesn't. Kind of a mentality. And I'm not sure how you fix that. You know, I don't know if there's really a fix for that. Because they knew that they shouldn't be doing it. So it wasn't a knowledge issue. It was an application issue. It was a heart issue, really. I mean, the person knew that they shouldn't be doing. I mean, several people at the company knew that they shouldn't be doing this, and they took great strides to hide it. So, that type of penalty to me seems like it was fair at this point. So, the second one that came out this week was for a Catalyst Technologies company. And their penalty was much lower. I mean, it was just under $4 million. I think it was 3.8 million. I do think the $2 amounts are quite different, clearly, but the same willfulness to violate sanctions were present in both cases. The former CEO of this company knew, again, that they shouldn't be doing what they were doing, and they took great strides. They even were involved personally in the payment flow so they could hide the end companies. They were talking about Iran with the letter I in the emails. They boiled it down because they didn't want the word Iran to be in the email, so they instructed everyone to just use the letter I as shorthand. And this went on for 5 years. There were other things that happened. They had cash payments involved because they knew that their banks wouldn't clear a wire related to Iran. I mean, there were other egregious violations that happened in the second case that kind of mimic the willful, you know, ignorance and criminality of the first one. But I think the difference, not just in the dollar amounts that were involved in the two cases, which makes a difference in the amount of penalties or in the dollar amount of penalties. But the main difference was the way in which the second company approached uh, when they found out that their employees were involved in product sales to Iran and Venezuela, and the speediness by which they remediated that. And I think when you look at the mitigating factors, there were, I think, 8 of them, which is a lot compared to the first case that only had one. But this is a good reminder. Any US company that has a non US distributor, has a non US subsidiary, and that subsidiary has distributors, and that subsidiary, that non US subsidiary, has sales agents, and that non US subsidiary has other suppliers for goods or services. Those, like, that's where you have to look at these lessons learned from the $3.8 million penalty and really try to operationalize that. What I said in my post, I think yesterday or the day before yesterday, regarding this latest penalty, was the amount of times, or I guess the number of times, I hear from financial institutions that either don't understand or don't remember that we have country level sanctions across the board on certain countries, and it's not just North Korea. And it's kind of jarring, right? I'll be on site with clients, and it'll come up in my normal discovery process for whatever project I'm working on, and I'll go ask them, "Hey, did you know that you have, XYZ?" And they'll be like, "Oh, I didn't, do we have to be screening this particular country element?" And I'm like, "Yes, you do, because we have country level restrictions." Now, not all country level restrictions are all black and white. They're all not North Korea. Um, we have certain country level restrictions that are more nuanced. I've talked about this before, so I won't go into it too much. But we definitely have more nuanced country level restrictions than we have, across the board country level restrictions. So if you aren't using certain country data elements on that countries list on the Treasury site, if you're not using those country codes as like your first trigger to review, then I would encourage you to do so. Now, remember, this is different than high risk country lists that most financial institutions have. If you're a non financial institution company, like this technology company that had non US subsidiaries, you have to make sure that that country information is available to you to screen. And I think that was one of the issues here. But I think once they found that they were dealing with an Iranian company, they took measures to obfuscate that data point, and that's what led to years and years and years of these violations. So one of the other things that it brings up, if you're a US company and you're using a supplier from China and they're routing products via your non US subsidiary or your non US distributor, I would make sure you have some type of oversight into that. Definitely have a good attorney that knows um, uh, export controls, sanctions issues. Look and review what is going on and the data points that are in there. Also, having an eye out for sanctions evasions, because that's what happened in this particular case. Also, if you are a U.S. company, not a financial institution, if you're a U.S. company and your non-U.S. distributors are providing your product or your service to non-US persons or non-US companies, you still have a responsibility to make sure that the person who ultimately ends up with your product or your service is not a sanctioned person, a sanctioned entity, or in a sanctioned country. And I think that gets lost. I think I said this last summer, when we saw this like flurry of um, sanctions penalties, that the US Treasury really needs to put out a kind of like a commercial, like they did with the beneficial ownership database. I'm not sure if anyone was watching any of the news stations last year when they kept running the FinCEN beneficial ownership database commercials. But something akin to that, but from a sanctions perspective. Hey, if you are a US company and you are involved in shipping your products overseas, please make sure that you're fully aware of your sanctions restrictions. And I do know that BIS is really getting in the mix on this, and that's been lovely to see, especially over the last 4 to 5 years. I've seen that the Bureau of Industry and Security are really, kind of folding into what OFAC is doing and vice versa. And I think that's good, but I still think there's a lot of blind spots, clearly, that are happening. And I think if you are a financial institution, some takeaways. If you're a financial institution, especially if you're a commercially focused financial institution, this should be front and center with your business email compromise, fraud, customer facing education. This should be right up there with it. Hey, are you a commercial customer involved in shipping, products or providing services outside of the U.S.? If so, please click here for a quick rundown of your sanctions requirements. The last thing that you want to be dealing with as a financial institution is a non-financial institution business, right? So you have a manufacturer of some kind or a technology customer of some kind, and they're switching things around on their end, and then you're clearing payments to sanctioned parties or countries, and you don't know because your downstream customer is much like these two that got the penalty this week. So definitely some things, more things to learn from in this one than in the larger one that was 215 or 216 million dollars. This $3.8 million one to me had more takeaways, even though the dollar amount wasn't as cool. But I thought there were interesting steps very quickly that the new CEO took that were definitely worth mentioning. And if you are a US financial institution and you're like, I don't want to be that guy that gets penalized, you should definitely look at all of the steps that the new management took as soon as they found out that they were involved in Iranian and Venezuelan payments, essentially. The number of steps that they took were severe, and they were very clear, and it resulted in what OFAC called a commitment to compliance. And that's the first time I've really seen that they've given that type of credit, at least in recent history, to a company. And I think it's because all of the steps that they took, from training to systems, they did their own look back, they got their own counsel, et cetera. And I think there's steps in there that can be taken by any company before it results in a penalty. So I would definitely encourage you to look at a few of the things that they did. All right. Last one, I want to get this in. So there was a quick lesson. Hopefully it'll be a quick lesson. It's very interesting. I think if you have time to read any of the things we talked about today, read this FINRA AWC that they issued for an AML officer at a firm. I'm not going to name the AML officer or the firm. It is public, but I don't want to go there. Okay. So this person was the AML officer, named AML officer at the securities firm from 2007 to 2022. What this FINRA order found was that from February of 2017 to December of 2022, that the named AML officer failed to reasonably supervise at any level 10 pages of instances in which this person did not perform their job correctly. As you read through this, there are nuggets for me that I find. Like there was a statement where they went through and they described how there was the um, AML officer that was in charge. She had 3 junior staff, and they devoted most of their time to functions other than the review and investigation of the surveillance reports that they were supposed to be looking at for suspicious activity. And the nugget for me is not that. The nugget was in one of the sentences, and I'm going to read this so I don't get it wrong. But it says the absence of escalations should have alerted this AML officer to the group's failures to perform surveillance of trading activities. And this is something I've talked about before. I cannot remember which episode, but and I do talk about it a lot when I speak in person, that when there's the absence of something, an absence of escalations in this particular case, that to me is a sign of ineffectiveness. And that's something that should be logged. You know, and to me, it's directly related to the lack of quality control and also the lack of good training. The same goes in a traditional financial institution, in a securities firms and fintechs. If you have outsourced aspects of your AML function or your sanctions function in any way, shape, or form, and by outsourced, I don't necessarily mean that that you have a third party that's reviewing everything. Even if you're relying on your branch folks to escalate issues to you, you're relying on your wires folks to escalate sanctions issues to you. You know, there's different aspects in which there is a kind of a decentralized approach to some aspects of suspicious activity, some aspects of sanctions, not all. If you've never received an escalation from a branch, something's wrong. And that's backed up by this statement that FINRA talks about. And I was very happy to see this plain language statement because I say that a lot. Like, if you're trying to manage or trying to measure ineffectiveness, a way to a way to measure ineffectiveness is to look at how many escalations you're getting from other areas that you safely rely on. Your private wealth area, you know, your wire area. If they aren't escalating anything to your sanctions function, to your AML function, they're probably missing something. They probably don't have the right mindset of things. They probably don't understand what suspicious activity really, really looks like. So definitely keep, you know, when you're reading these types of lessons learned, it's not like, hey, look at that person, they failed. That's not the point in this. The point in this is to make sure that you're also not caught up in some of these downfalls. And so if you're listening to this and you go, oh man, you know what? I've never received an escalation for odd or suspicious activity from this branch. And, you know, or it's been 6 months since I've received anything from the wire department on sanctions. And I know we're in a particularly busy sanctions time. I should probably reach out and just double check. I should go in and look at what they're doing, look at the things that they've dispositioned on their own, things that they've resolved on their own, just to make sure that they're making the right decision. And I know that's easier said than done because that comes down to time. And I know most people don't have enough time. But this is where that quality control, that quality assurance, I call it a QX function. I don't care if it's control or quality assurance. It just has to happen. So, and we did start to see that last year and the year before that, we saw federal banking agencies start to have an expectation of having a quality control function, even for small banks. So if you're if you still don't have a QC person, try to figure out, is there somebody that's really good at the hunting part of of their job? Because if they're really good at hunting, hunting down problems and things like that, they'll be really good in that quality control function. Okay, so back to FINRA. That's definitely a lesson learned for all financial institutions of any type. But one of the other things that I noticed was that they went through and they talked about how they had these daily AML reports that were assigned to this group and that they went unreviewed for 2 years or longer. And I will say most financial institutions are pretty good at, keeping up with their alerts and reports that they're reviewing. Securities firms, this is not the first time that we've seen this. So if you're in a securities firm and you have AML AML requirements for now, which come in January, you might have all of your business, all of your registered investment advisors, instead of just a few, might now be under AML rules. And this is where you have to make sure if you have a report that's being produced and it somebody has to do something with it. If you don't do something with it, even if it's just, hey, this report was something that somebody set up several years ago and we find no value in it, but we're going to instead implement this type of report, that's fine, but that needs to be documented. But in this case, this was not what happened. They had 2 years or longer where they had these reports that were being produced, and the group was doing other things besides reviewing the suspicious activity. The other lesson learned here is that this securities firm dealt with foreign financial institutions, and there are specific requirements that are laid out from an AML perspective when you're dealing with foreign financial institutions. But this particular one had FATF jurisdictions that were high risk, and they had nothing to show for it other than that data showing that they were dealing with high risk countries according to the Financial Action Task Force. They had nothing else backing it up. They did not have enhancement of procedures. They did not have any actions that supported this higher risk type of activity. They had for, I believe, 4 years, three or 4 years, they had a generation of a report that would come up, and then the report stated, so the report in and of itself was wrong because the report stated there was no trading occurring in any of the U.S. customers' accounts, even though trading was actually occurring. So I guess it goes back to my last point, which is if you have a report and you're actually supposed to be looking at it, you need to make sure that the report is correct. And there were several other issues in this FINRA report. It goes on for 10 pages. So if you're a securities firm and you're trying to make sure that you have the most sound program before the new requirements kick in January, I would encourage you to read through this particular one that was published, I believe, on the 16th of June. It's the only one that has AML in the description of the consent order on the FINRA site. So I think I covered enough. I hope I covered enough lessons learned. Would love to hear from you. Please keep the comments coming. Please don't forget to like and subscribe, and send us an email, FinCrime Unfiltered at illicitedge.com, or find me on LinkedIn at I Follow Dirty Money. And thank you for listening, and we'll see you next week.